Hey, Mark Walters here. I'd like to welcome you to the call right now and take this moment to say thank you very, very much for your support. I've had so many different people that have enjoyed the things that we've shared over the decades, and today is the most recent, and it's an incredible time to be a real estate investor right now. We're going to be talking about that both from the standpoint of if you're a new investor, great. If you are somebody who's done some deals, but you want to do more, great. Or if you're somebody that wants to scale your business even more, the timing is really good, both from the macro and the micro. Possibly one of the best times in our lives to do something like this. Now, there are different types of real estate markets throughout our life where we can be doing different things. Some are better than others. I've been in markets that have been screaming hot. I've been in markets that have been going down. I've been in markets that have been flat, where you think, well, gosh, what's going on? When I first moved out here to Phoenix in 1992 from the Bay Area, after it was experiencing the savings and loan crisis of the late 1980s, early 1990s, well, when I was buying houses, they were just flat for a while. And coming from the San Francisco Bay Area, I was not used to that. And of course, then the early 2000s, we've got loans that shouldn't have been made again. And we had another crisis. So a lot of times we think of the saving, or we think of the loan debacle of the early 2000s. Well, it wasn't that long prior when it had happened again, or first. So about 15 years prior, give or take. So anyway, different markets give us different opportunities. And where we are right now is we've had these historically low interest rates. Some would say they are a government subsidy to try and help us get through the challenging times that we had. There were trillions of dollars being printed, and we had challenging times, and we had the pandemic, and we had these really, really low rates. Certainly prior to that, we had low rates that a lot of people would say, hey, these are great. You know, anything under 5%, you're in the fours, like, wow, this is just incredible. And then they went even below that into 3, sometimes maybe a little bit less, but you've got just really sweetheart loans. So where does that leave us right now? Well, first of all, I want to thank you for getting my bargain house course on how to find bargain houses. So that dovetails nicely with, well, how can I be acquiring these properties or controlling these deals with as little money out of pocket now that you have all these different ways to be able to uncover bargain houses? And right now, of course, after the steam engine that was the market not too far back, we've got people in different markets that are having some struggles. We've got some markets in the country that are still a seller's market. We've got other markets that you'd want to stay out of. And you've got people that are experiencing the economy that is also their own personal economy that they need to get out from underneath their loan payment. So that puts us in a position of a helper. That's how I've always felt about this. My grandfather, he started investing back in 1937 during the Great Depression, bought property, and his core value was helping people. He was an entrepreneur, and certainly back then there were a lot of people that needed help, and he helped them. And that was a philosophy that he passed down to my dad, who then passed it down to me. So anytime we have the chance to be uncovering and marketing to distressed homeowners, of course, those are the people that are going to be receptive to our creative real estate investing offers, and also the people that really need our help. And a lot of times they take their problem with them financially, but their biggest challenge that they had was making this big loan payment that is on their house. And so I always like to provide as much help as I can, not just from the standpoint of buying their house or offering to buy their house, but also understanding that there's a lot of moving parts in their life. They've got family, they've got pets, they've got things, and they need help so that they can survive this, not just sell their house. And as we put on the helper hat, we then take a lot of the pressure off of ourselves, because we're really just trying to find out what these people need. And we do that by building rapport with them and having some trust, having the conversations so that we can really find out what they need and then offer them what is going to be the solution that they're hoping for, creating a win-win scenario. Now, at the same time, some of these houses have sweetheart loans on them. And in some cases, we can then step into those loans, which leads us to the conversation that is the topic here, and that is how to be buying houses with little to no money. Now, it's not just stepping into a subject to loan. We're going to be talking about some different things here, but I would be remiss if I didn't say how significant the fact that there are these low interest rate loans, and we've got people that are in a distressed homeowner scenario that need our help in understanding that part of that help could be taking over their loan payment, particularly if their credit is being ruined because they stopped making their loan payments. They've got not only a notice of foreclosure, they've got a notice of sale. So they've got a scenario here where there's a hard deadline and there's not a lot of time. And so we then find out, well, what is it that you really need right now? It's really not, well, I want this for my house. It's like, well, hey, I need X amount of dollars. I need to move on. They might need different things. I mean, they're going to need different things. That's why we want to listen to them. And we can be positioning ourselves so that part of the solution could be, well, listen, what if I could just, instead of going out and spending all the time and expense to get a new home loan that, we don't really have the time for that. It's more expensive. It's going to cost a lot. That's going to affect the bottom line here, the numbers. What if I just started making your loan payments, got them current, made up all the fees and the back payments, things like that? Your lender's going to be happy, and that's going to start helping your credit from this moment going forward. And we don't have to spend the time going out and getting a new loan, talking traditional type of a purchase. And that starts to get the conversation going like, hey, a lot of times people don't even think about that, didn't even know they could do that. And it does have the chance to help them as far as their credit is concerned. Sometimes people say, well, what happens if somebody goes to buy a house down the road? Well, certainly that's not going to be their first choice for a while, considering they've got a lot of challenges financially. But if that does happen, there are some lenders, I'm generally speaking here, and I'm not giving any legal advice. I'm not an attorney. Also, as I'm sharing these ideas, there are some lenders that will take into consideration the fact that the house was sold subject to the underlying financing. So obviously someone's name is still on the deed, even though you're buying the property, getting the deed to the property. I should say, excuse me, let me go back here a second. Somebody's name is still on the loan. It's not on the deed because you're getting the deed. Your company name is on the deed. Their name is still on the loan. So they've got that scenario, but at the same time, you've bought it subject to, there are some lenders that will understand that situation so that it's not such a penalty on them for that consideration if they were to go and try and get another loan. So again, to say their name stays on the loan, but you're getting the deed, your company is getting the deed, and you're controlling that property. And it's significant because, like I said, they've got a financial scenario that's challenged that they are then taking with them. Chances are it's not like you buying their house is just going to fix their finances. They've got a problem for a reason. They are missing payments for a reason. And it could be a lot of different reasons, from job loss to marital changes to health issues to a lot of things, right? So they're taking their situation with them. And if they were to file bankruptcy down the road, if you did not have that deed signed over to your company or yourself, well, of course, that's something that creditors can potentially go after. But in the situation where you're getting the deed, they no longer own the property. I've had that situation happen before where somebody sold their property to my business got the deed. My business was the legal owner. These people moved on, and I bought the property subject to, and they filed bankruptcy. There was nothing that could be done because they no longer own the property. So I just wanted to bring that to your attention, particularly if you are ever thinking of buying property or securing property with little to no money using a lease with an option to purchase. I never suggest doing that. A lease with an option to purchase is a great exit strategy once you've got the deed to the property, so you can be offering it to somebody who comes with a non-refundable option consideration, and then they're making payments. So they're giving essentially a lump sum up front that they could potentially lose. It's non-refundable if they don't exercise their option. 2 different contracts. So as far as an exit strategy, great. So they're coming in with money, they're paying above average rent, and then they're paying off the rest that they owe when they go to refinance down the road. So an exit strategy when you're selling, great. I should say a lease with an option to purchase as an exit strategy, great, but not as an acquisition. Because let's say you went and you controlled a property from somebody who's a motivated home seller who moves on with their life, took their financial problem with them, and you weren't able to get the deed to the property. Let's say you have this property and you go and because it's not your property, but maybe you want to put someone in with a lease with an option, and then they file bankruptcy. Then you've got a family in there that trusted what you were doing with them, and yet you didn't own the property. Now the property is being foreclosed on. These people are thinking they've got a lease with an option to purchase this property. That is something I would personally never do. I always get the deed, then I consider my exit strategy. And I usually know what the exit strategy is before I get that deed, because it's important that we know what you're going to do with the property before you get the property. So that way you're not holding a property that you don't have an exit strategy. Maybe it's not going to be a good wholesale deal. It's not going to be a lot of things. And you're like, oh my gosh, this is not a good situation. Always want to know what that exit strategy is going to be. But I highly recommend that you get that deed if you're not just assigning the contract. If you're getting the deed to the property, then of course, those people that had bought the property originally that you're buying it from, they take their financial challenges with them, and you've now owned that property. So that's an important distinction. I just wanted to make that perfectly clear, particularly for this topic, where we're trying to get property for little to no money out of pocket. So there's right ways to do things, and there's other ways to do things. So I just wanted to share that is my opinion on that for good reason. And also, as we're talking about this, let's talk a little bit further about the subject to scenario. Subject to's, buying a property subject to the underlying financing. Simple terms is taking over the payment. As you've gotten the deed to the property, the home seller's name stays on the loan. They move on. You control that property. It is your property because you've got the deed, and the payment is low. So you've got some considerations here. Are you going to, well, first of all, if there wasn't a lot of equity in the property, it could be that you're getting that for very little money. It could be, depending on the scenario, maybe they're like, I'm going to sign over the deed. You've got to make up some back payments. Maybe you give them a couple $1,000s to move on. It could be something like that because people need money to move. So very, very low amount considering traditional ways of having to come up with big down payment and things like that. The other thing to consider when you've got a low interest rate loan that you have acquired this property subject to the underlying financing is, what are you going to do with the property? So are you going to sell this property on payments? Are you going to offer this with a lease with an option to purchase? Because hopefully that monthly payment, principal, interest, taxes, and insurance, yes, there could be homeowners association on there. There could be, whatever is a monthly revolving charge. Hopefully the rent is going to be much higher than that. And as we know, rents have gone up a lot. So if somebody has bought a house with 3% financing, it could be that monthly loan payment is much lower than what you could charge for rent. If you were to keep the property, and then offer it with a lease with a purchase, you're still renting it out, but you've got a different kind of a scenario there. It's not just for the cash flow. It's the cash flow, the upfront money, the back end money, and that can really be nice. It could be, if you are trying to keep as much money in your pocket as possible, maybe somebody will do a subject to deal, a seller said, yep, I will do that, but they've got some equity and they want some money. You think, well, gosh, I want to try and keep as much of my money in my pocket as possible, or I just don't have the money. You might be thinking to give them X amount of dollars, depending on the situation. So you could consider bringing someone in who's got the money and kind of have where you're You're splitting the profits on that deal. Maybe you could set it up however you want to do it. You might get some private lender money. You might also see if the seller is willing to do some kind of a carryback loan, particularly if you're not living in that property, right? And when you start to think about the Dodd-Frank rule and things like that. And so you've got the scenario like that. And then if they need some cash, you might say, well, how much do you really need? And that's where the rapport, the trust building, the relationship as you're conversing with the seller, truly trying to help them. I always like to say, I like to talk to people. I like to try and help them because I know there's ways that people need help besides just selling their house. So I put that hat on. So there's no expectations. If I don't sell their house, so I shouldn't say, if I don't buy their house, if they don't sell their house to me, if I've at least helped them, I haven't spent a lot of time in that scenario, but I've helped them. But at the same time, I've also given a lot, expecting nothing in return by some of the things that I will share with them and provide to them that can help them in different areas of their life, which of course is going to help with building rapport. So then as they realize this isn't somebody that's just trying to take advantage of me, this is somebody that's truly trying to help me, building that rapport and having fun as well. I like to have fun, joke around, whatever. There's certain questions I'll ask, to get people to relax and me to relax. And I just like having fun. I enjoy conversations with people when it comes to horse trading, anything. It's just fun. And in this situation, we've got to respect them. We've got empathy for their situation, but it's also nice to have some fun and loosen up the situation because I'm sure they're having some of that at different stages of their day. And then you can find out what they truly need. And once you know what they truly need, it's like, well, I need $10,000. You're talking to someone. Listen, I really want to help you. I really want this to work. What do you really need? Well, I need $5,000 or I need $6,000. Okay. If I can get you that, would you be willing to carry some back? Well, yeah, because I really just need this. That would help me a lot because the clock is ticking. They're motivated. You're their person. So that's another way to help keep some money in your pocket too. And please, when you are structuring any type of a loan, you're structuring it. And, in this case scenario, that seller is carrying back. A lot of times when we think about loans, we naturally just think about loans in the context of, well, we pay monthly payments on a loan of whatever kind. It could be a car, a boat, a house, revolving credit. We're just used to paying monthly payments that have a certain interest rate on it. So those are different types of loans, of course. But, and in the case of a traditional house loan, you've got the front-loaded interest. So even though the interest is low, the lender is stacking the deck in their favor so that there's more interest paid at the first 20 years of the loan than the latter part. Quite something to be the lender, but they have a lot of control when they are creating the loan. And so do you when you're creating the loan. So please realize you don't have, first of all, you just need to know what their needs are, but you don't have to have it be a monthly payment. It could be a quarterly payment, twice a year payment, once a year payment, or just you're going to pay it all at the end, which is a balloon payment. There doesn't have to be any interest if you don't want, or it could be a very low interest rate. Again, we're dealing with people that are motivated. So I just want to plant that seed as you're thinking, well, I'm going to create some financing. And we just go to what we naturally are thinking of if we have never done something like this before. It's like, well, there's monthly payments, so there's some interest. Okay, so what would that be? Well, no, it doesn't have to be any of that. We're just trying to keep as much money in your pocket as possible. And when it comes to creating financing and creative financing, please realize that you're the painter here. You're the one that's deciding what colors go where on the canvas, so to speak. How'd you like that analogy? It just came right off the top of my head. But please don't just revert to what we're used to. I did that on a contract years ago. And luckily I didn't have to go through with that particular scenario because I was so new and I knew of just a certain way of doing things. But as I learned more and I got some advice, particularly at that time, it's like, hey, you don't have to do it like that. Okay, great. Because we can all learn, especially in the beginning. So those are some ways to keep some money in your pocket. Another is if you are assigning the contract, and that's where you're getting some kind of a fee for an investor buyer actually coming in and closing the deal for you, their money, all of that. You're not buying it, you're not selling it as far as the property, because you don't own the property. You own the contract, and you're merely assigning that contract over to the real estate investor who's going to come in and actually perform on the stipulations within the contract. So in that case, you've got different scenarios when it comes to the assignment, especially when you've got different relationships with investor buyers, wholesalers. Who knows what they're going to do with the property? Is it for their own portfolio? Are they offering it to somebody else? What's the deal there? But when you've got some relationships with investor buyers, you can find out what they're looking for. Are they looking for properties with phenomenal terms, subject to type of scenarios where the interest rate is really low, 30-year fixed rate, around 3%, so that they can then recognize the value of the low payment so they can put that property in their rental portfolio? Or maybe those investor buyers know of investors that are looking for that. So in that case, you're structuring your offer so that it's going to be favorable to not only that investor, but you know what their criteria is. So you know your maximum allowable offer, and you've got to work in fees and all those kinds of things as well. And then you're working in, okay, how much is this person going to pay me for this contract? And you're going to get paid at the end of closing. And then that's great. You're going to be getting some kind of a deposit as well. So if they don't perform, you're going to get paid. That's not good for the seller. You don't want that. But point being that if you've got some relationships too with different wholesalers, you can pivot, shift, and see who can close really fast. But by knowing what some of their exit strategies are, you know the type of deal that they're going to be interested in that contract. At the same time, you're not having to come out of pocket for, anything that's in that contract as far as the performance on that loan. Is there some money that's going to be required? Hey, it's not being required by you because you're assigning that contract. So that's another way that you can be doing deals with very little to no money out of pocket. In that type of a scenario, you might have somebody that's interested in a landlord scenario. You might have somebody that's going to come in because who knows what their exit strategy is. They're just saying, hey, this can be a cash offer. I just need a good price after repair value, all those kinds of things worked into it. And then you're putting the deal together in the way that it's going to be a cash deal, but it's not your cash, because again, you're assigning that contract for a fee over to the investor buyer. And whenever you're doing any assignments or anything like that, never promote as though you're selling a house, because you don't own the house. That'll get you in a lot of trouble. You've got a contract. So just remember that. You've also got the scenario that is the double closing if you are not assigning that contract. So a double closing can be where you are actually buying that property for about a second or two or three, and then whoever you're selling it to is buying it from you. Two separate transactions, two different sets of fees. And there are a couple of different ways to go about doing that double close. First of all, you've got to have a title company, a closing company who accepts those types of creative deals. So if you are not finding a closing company that will do either assignments or double closings, things like that, keep looking. Talk to other investors in your area and say, where are you going to get these deals closed that understand investor deals? And of course, what better source for that answer than the investor buyers that you're assigning these properties to, or that are doing the double closing, things like that. So the relationships are really helpful for many different reasons. And when you're doing a double closing, there are a couple of different ways that you can, that I'm going to talk about here anyway, that you can be doing this. One is where you got to come up with money. Another is where you don't have to come up with money. your end buyer is coming up with the money. So preferably, if you have a closing company that's willing to do this, if you're contracting with the seller, and then you have contract to buy, you're legitimately buying this property, you're going to get the deed at title, and then somebody is going to buy it from you immediately, an investor buyer. They're coming in with the cash, and the cash, their cash coming in is being used then for you to purchase that property. That is a dry closing. It's their funds. That is a way that some people consider not putting their own money into a deal. Another would be a wet closing. That's where you are coming up with the money to buy the property. In this double closing situation, you're getting the deed. It's a separate transaction. You're then selling it to an investor buyer immediately within seconds, and they've got their own financing. They're buying it. So you might be thinking, well, Mark, I don't have that kind of money to do that kind of a deal, let's just say. And that's where transactional funding comes in, where you can get a transactional loan for a day just for that, and you're going to pay some points for that. Points are merely a percentage of what it is you're borrowing. So if you're borrowing $100,000 and it's 3 points, there's $3,000. So work all that into your deal as you're writing it, but always understanding the exit strategy and the person or the business that's on the other end, the relationship, that investor buyer, and having more than one in case something were to go south, some reason they can't close on the deal or what have you. So another way to look at some of this as you are putting deals together is you've got your acquisition, which should dovetail with your exit strategy, which then there are positive potentials when you dovetail that with your closing and with the way that you're closing deals. So whenever you're considering a deal, you've done some marketing, you know why you're marketing, and you know where you're marketing, you know who you're marketing to and why. You know that for some reason they've got a lot of motivation. They need to get out from underneath that payment. A lot of times that's going to be somebody who's behind on their payments. They've got a notice of sale coming up. There's a hard deadline because there's a date that that lender is going to sell that property. These people have a real situation. So then you're understanding, all right, you know, you're reaching out to them and you're listening, you're building the rapport, you're finding out what their real needs are and what the numbers are. How much is owed? What's the value of the property? What type of repairs need to be made? Things like that, generally speaking. Then you're doing your due diligence as well. But you've also got some relationships with wholesalers, some investor buyers. You understand what it is they're looking for. And so as you're starting to talk to some of these different sellers, you're piecing that together. You're dovetailing, all right, this deal would be a good acquisition of a subject to, let's just say, you're buying the property subject to the underlying financing, let's just say, and let's say you're assigning the contract to this investor buyer because you know this deal fits the criteria that they're looking for. And you know what that assignment fee would be, all of that. And then you're thinking, all right, I can go to this closing company and they handle assignments, or I'm going to have to come in and maybe we can do a wet closing where I'm using transactional funding. So you can see where it's like three puzzle pieces, but as you are marketing and starting the conversation with people and starting to get information about that particular property, think about, all right, this closing company does these kind of deals. Here are some of my type of closings that I can do. I know that I really don't want to have to bring in money. I really don't want to do a double closing. I really want to do an assignment if at all possible. And I know there's a lot of conversation out there about assignments. So always talk to a good real estate attorney in your area to make sure you're doing everything above board and lawfully and properly. I always suggest that. And make sure you're handling how you are contacting people appropriately when it comes to having a contract to sell. But as you know, all right, I've got this piece. I got the closing company. I know that they are somebody that, or a company that understands the philosophy of creative deals. And then you've also got your exit strategy in place because you've got the relationships. You understand what it is they're looking for, the buying criteria that they've got. And then you start to then look at the numbers and say, okay, is this going to fit? Is this going to fit that kind of a scenario for an investor buyer? Or is there not enough equity in the deal? And you might consider then taking over the payments, giving these people very little money, and then seeing what you want to do with that property. Are you going to lease it with an option to purchase, get some upfront money, $10,000, $20,000, $30,000 up front, have a short term on that where you're only letting people, into that lease with an option to purchase, two separate contracts that have the chance, the real ability to be able to qualify for a loan in, 12 to 24 months. They just can't do it now, but they want a house of their own. And so you've got the deed to the property. You didn't have to give much because the people didn't have much equity. They didn't have much choice. They couldn't go out and list it with a real estate agent because, they don't have the 5 or 6%. I mean, if they knew somebody, maybe they'd give them a discount of 5%. Usually it's going to be 6%. They don't have that kind of money. They also don't have in the house equity wise to pay a real estate agent's commission or maybe any of those fees traditionally. Maybe they've got repairs that need to be done, that aren't so dramatic that it's going to make it a horrible deal. Obviously, we don't want to just take over somebody's problem unless there's some real reason to do it. And compensation wise, this is a business. So, but understanding once you're hearing these numbers, there's this flow, and it's always nice to think at the very end and work your way back. If you've already got the closing company, which you need to find that out, what they're willing to do. Great. You've got the people who are willing to be on the buyer's side, investor wise. Great. So then when you're unwrapping the numbers of the deal, you understand the time frame of when these people absolutely have to get it sold by, and you understand the numbers of the financing, the value, the repairs, any of the back payments, any of the fees, any attorney fees that are associated with the foreclosure scenario once they just haven't made enough payments and it's gone to this notice of sale. And you understand, okay, great. I've got an exit strategy in place, or this still works for me. I just layered a bunch of expenses, but it doesn't have to be like that. So these are different ways to creatively be thinking about getting into a real estate deal with little to no money, depending on the scenario. And it could be that in situations where somebody has very little equity, but still you're going to get some of their equity. Great. They might need a little bit of money to move on. Okay. An assignment, of course, you're using no money, spending some money on marketing and education and things like that. And of course, with the double closing, that's again, short-term money. If you're bringing funds in and somebody else's money, if you're not bringing funds in, if that's something that is accepted and all of that, you're doing your due diligence, with your real estate attorney, with your closing company, all those kind of things. You know what I'm saying? We always want to be careful because things change. So as I record this, I want to be general because things change. But I wanted to approach this session here a little bit differently because we've been hearing about no money down scenarios for a long time. But as you can see, there are ways to structure things where there's very little money out of pocket. And we've gone over a number of them right now. So I hope that gets you excited, particularly as I come back around to what we were talking about at the very beginning, the timing, the macro timing with millions of loans that are incredibly low interest rates, 30-year fixed, 3%, give or take. It's just an amazing opportunity, especially since the economy has changed. It's not like the real estate market is the freight train that it once was as I'm doing this. And you've got a lot of people that you can help. So your timing is good. That's why I wanted to make available not only my training on the 85 ways to find bargain houses. We first need to uncover people that are willing to have, or I should say, that have a motivation where they are willing to let a house go at a bargain price. But then also, what are the components that make up a deal where you don't have to come out of pocket much or any, depending on the situation? And we've gone over some that is both. no money, and then maybe some money, and then how to do things creatively if there's some equity in the deal there. And that's really what it's all about. So I also said, if you're just starting, that's terrific. Understanding some of these components can really be helpful. In the beginning, if you want to be doing some flipping so that you're not having to close the deal until you get some momentum, great. If you've done some deals, but you want to do more, here you go. There are a plethora of people out there all over the country that could use somebody who understands how to help them. I mean, that's really what they're looking for. And if you're looking to scale, you can be putting all of these things together, understanding that with millions of loans out there that have really low interest rates, if you're looking to do subject to deals, fantastic. Otherwise, you can just help them in a lot of different ways, like we've talked about. It doesn't have to be a subject to, it could be a cash deal as well. It could be a number of different scenarios, but understanding what people are looking to buy from you, then that's really helpful. So again, I thank you very much for investing in my Bargain House Dominator training. I hope that it gives you a lot of ways to be able to find bargain properties regardless of where the market is going. I've been in all of them, and it's important to know that you just shift some of the strategies. And then these are not only the techniques that we talked about here. It's not just if you don't have the money. It's also, I don't want to spend the money. I don't want to put money into these deals that I don't have to, because I want to scale as well. And I don't want everything in one deal, and there's a time and a place for different scenarios. But this training was on how to be buying houses with little to no money. So I hope that helps. It's a perfect companion with how to find bargain houses. And now you have some ideas swirling around on how to be doing deals with little money, and rinse and repeat, and just have fun with it, knowing that you're going to help a lot of people. Again, thanks for your business, your support. Thanks for opening up my emails. It means the world to me. Thanks for enjoying my silly animal posts as well inside of the emails. It's so much fun. I love animals. So nice to be able to share it all with you. Until next time, I'm Mark Walters, and I'll share more with you very soon. Thanks again for your support. Bye.